Welcome back, NetJRF aspirants. Today, we are diving deep into the captivating world of sources of finance. In this knowledge-packed video, we will explore various avenues businesses can take to secure the financial resources they need to achieve their goals. So, let's get started. Before we delve into the various sources of business finance, let's first understand why finance is the lifeblood of any successful venture. Whether a startup seeking to launch a disruptive innovation or an established corporation looking to expand their operations, having a diverse and reliable range of financial sources is vital. Thus, dear learners, the sources of business finance can be classified into two broad categories, namely, long-term finance and short-term finance. What is long-term finance? Short-term finance means capital requirements of a business for a period of more than 5 years. They are required for capital expenditures in fixed assets. They can be different form, such as equity share capital, preference share capital, term loans, debenture or bond capital, lease capital or leasing, retained earnings, and venture capital. Now, let us discuss important long-term sources of finance. First one is equity share capital. It is a basic source of finance for any firm. It represents the ownership interest in the company. It is characterized by the direct consequence of its position in the company's control, income, and assets. Equity share capital does not have any maturity and there is no compulsion to pay dividend. It provides funds on a permanent basis. The second long-term source of finance is preference share capital. Preference share capital mean owner's capital having a maturity period. In India, it must be redeemed within a maximum period of 20 years from the date of issue. It offers a fixed rate of dividend. It has two preferential rights. Number 1, preference with respect to payment of dividend, and number 2, preference with reference to repayment of capital in case of liquidation of company. Another important source of long-term finance is debenture or bond capital. Debenture refers to the basic debt instrument which may be issued by a borrowing company. It carries a promise by the company to make interest payments to the debenture holders of specified amount, at specified time, and also to repay the principal amount at the end of a specified period. Retained earnings is another important long-term source of capital. The portion of profits not distributed among the shareholders but retained and used in the business is called retained earnings. It is also known as plowing back of profit or retained capital or accumulated earnings. Now, what is short-term finance? Short-term finance means financing for a period of less than 1 year. The need for short-term finance arises to finance the current assets of a business. It is also named as working capital financing. Short-term finances are available in various forms, including trade credit, accrued expenses, commercial paper, intercorporate deposits, short-term unsecured debentures, bank credit, hire purchase system, forfeiting, bill discounting, factoring, and securitization. Now, let us discuss some of the important short-term sources of finance. Important one is trade credit. When a firm buys goods from another, it may not be required to pay for these goods immediately. During this period, before the payment becomes due, the purchaser has a debt outstanding to the supplier. This debt is recorded in the buyer's balance sheet as creditors. The amount of such financing depends on the volume of purchases and the payment timing. Small and new firms are usually more dependent on the trade credit, as they find it difficult to obtain funds from other sources. It may take form of open account or bills payable. Another important short-term source of finance is commercial paper. Commercial paper is an unsecured promissory note issued by a firm to raise funds for a short period, generally, varying from a few days to a few months. In India, the maturity period of commercial paper varies between 15 days to 1 year. It is a money market instrument and generally purchased by commercial banks, money market mutual funds, and other financial institutions desirous to invest their funds for a short period. As the commercial paper is unsecured, the firms having good credit rating can only issue the commercial paper. Next important short-term source of finance is bank credit. Bank credit is regarded as self-liquidating in the sense that the uses to which the borrowing firm is expected to put the funds are ordinarily expected to generate cash flows adequate to repay the loan within a year. Further, these loans are called self-liquidating because the bank's motive to provide finance is to meet the seasonal demand. Forfeiting is another short-term source of finance. The term forfeit simply means relinquish a right. It refers to the exporter relinquishing his right to a receivable due at a future date in exchange for immediate cash payment, at an agreed discount, passing all risks and responsibilities for collecting the debt to the forfeiter. Forfeiting transforms the supplier's credit granted to the importer into cash transaction for the exporter, protecting him completely from all the risks associated with selling overseas on credit. It effectively transforms a credit sale into a cash sale. Another important source of short-term finance is bill discounting. Generally, a trade bill arises out of a genuine credit trade transaction. It is drawn for a short period of 3 to 6 months and in some cases for 9 months. The buyer of goods accepts the same and binds himself liable to pay the amount on the due date. In such a case, the supplier of goods has to wait for the expiry of the bill to get back the cost of the goods sold. It involves locking up of his working capital, which is very much needed for the smooth running of the business or for carrying on the normal production process. Bill financing is the most liquid one from the banker's point of view since, in time of emergencies, they can take those bills to the RBI for rediscounting purposes. The last one is factoring. Factoring may be defined as the relationship between the seller of goods and a financial firm, called the factor, whereby the latter purchases the receivables of the former and also administers the receivable of the former. Factoring involves sale of receivable of a firm to another firm under an already existing agreement between the firm and the factor. And there you have it, dear learners, a comprehensive exploration of the captivating sources of business finance. Remember, a well-rounded understanding of these sources and how they intertwine can shape your business's future. Let's continue to dive deeper into the ocean of knowledge together in our next video. Once again, thanks for watching.